Hello and welcome to The Reluctant Investor, and I want to apologise for the lack of new videos on the channel over the last couple of weeks. My aim is to make one video a week, but I make these videos solely on the weekend and outside of work hours, so when my day job spills over into the weekend, or in the rare instance that I actually have plans outside of work, sometimes TRI, as all the cool kids are calling it now, can get neglected. Today's video addresses one of the most commonly asked questions, particularly among people who are new to or have only recently begun to research the idea of investing, and those are the types of people that I want to help most with this channel. I must clarify before I begin, given the nature of this video, that nothing in it should constitute advice or any kind of recommendation. I am not a financial advisor or professional wealth manager. I'm someone who makes obscure YouTube videos about football for a living, and I'm not even really qualified to do that. So make sure to always do your own independent research or seek out the advice of a financial advisor that you can trust. Don't just listen to an idiot like me. Hopefully that is a satisfactory disclaimer for my non-existent legal team. With that in mind though, and purely for entertainment purposes, today I wanted to grapple with a question that I'm often asked, both by all of you wonderful people since starting this YouTube channel, and by family and friends who are curious about investing in general. And that is, when is the best time to invest? Or, sometimes, by those who have done a little bit more research and are a little further down the road in terms of this path, should I invest now, or should I wait for the market to drop, or even for a full-blown stock market crash of the kind that we see, on average, roughly once a decade before investing? For those of you who aren't at that stage and may be unfamiliar with the context of the second question, the stock market, broadly speaking, is either at or is very close to being at all-time highs, unless there has been a screeching crash in the time between me recording this video and it getting uploaded. Depending upon your definition of a bull market, which just means a period of time in which investors are optimistic about the future and prices of stocks increase, there was a bull market lasting at least 8 years from 2009 onwards. There was then a slight correction in December 2018 before a fairly sharp correction, a crash really, just over a year ago at the start of the COVID-19 pandemic. However, following both of those two declines, the stock market very quickly recovered and climbed to yet new highs. In short, stocks are expensive right now, in historic terms, which means that the overall stock market is expensive as well, which leads some to believe that stocks are overvalued and that we are due a market correction or crash, and that you will then be able to pick up stocks at much cheaper prices, reaping the rewards as the market rises in the coming years. It's not terrible logic. Warren Buffett, often hailed as the greatest investor of all time, famously said that you should be greedy when others are fearful, and fearful when others are greedy. Essentially saying that the time to buy is when stocks are badly beaten down, not when they're at all-time highs. Though Buffett himself didn't really follow that line of thought during the last market correction, as a net seller of stocks when the COVID-19 stock market crash arrived. John D. Rockefeller put it even more starkly, famously stating that the way to make money is to buy when blood is running in the streets. So, should you hold off on buying any stocks or any index funds right now? Well, not really. Or at least, I wouldn't. And here's why. Buying stocks when the market is down and when others are fearful does not mean not buying stocks when the market is up and others are optimistic. I'll say that another way, just in case it isn't clear. Whilst it obviously makes sense to buy stocks as cheaply as possible, in the same way that you would always look to buy a house, car, or your supermarket shop for the lowest possible price without sacrificing on quality, that doesn't mean that you cannot invest when stocks seem expensive, particularly if you are investing passively by buying the entire market, or at least an entire market. If you're investing in individual stocks and companies, then the story is a little different, and I'll come to that in a moment. As is so often said, no one can time the stock market, at least not with any degree of accuracy or consistency over time, hence why the vast majority of traders lose money. There will be market corrections and crashes in the future, we know that for a fact, but you don't know when they will arrive. If you invest today and there is a crash tomorrow, you would have been better off holding off for that extra day. But if you hold off on investing today in anticipation of a crash or correction which doesn't arrive for 5 years, during which time the stock market has climbed 50%, you would need an absolutely catastrophic crash just to break even in terms of having sat out of the market for all of that time, and for having missed out on all of those gains. To give a practical example, let's say you invested £1,000 in the S&P 500 in October 2007, just before the 2007-08 financial crisis. Your timing couldn't have been much worse. By February 2009, the market had declined more than 50%. Your £1,000 investment would now be worth just £475. This was the reality for a lot of people during that time, some of whom panicked, thinking that their savings, investments, or pensions would keep falling to zero, so they sold them, thus cementing their losses. However, for those who held on, their £1,000 investment in October 2007 would now be worth £2,700. They would have almost 3x'd their money despite investing at the worst possible moment. Of course, their returns would be even greater had they invested that £1,000 in February 2009, but at that time, no one had any way of knowing that September 2007 would be a peak, or that February 2009 would be the market's nadir. There is a saying in investing that time in the market beats timing the market. And what that means is just keeping your money in the market when you're investing passively in a whole basket of stocks is a better strategy than trying to predict something which you simply cannot predict. Time in the market wouldn't beat timing the market if you could actually time the market, but if you could actually time the market, you'd likely be the richest person in the world, and you certainly wouldn't be listening to me. If you are essentially fearful about investing a large lump sum of money and then a crash wiping out a hefty chunk of your holding in the near future, then there is something called dollar cost averaging. That just means that instead of investing, say, £50,000 in one lump sum, you invest roughly £4,000 a month for a year, or £2,000 a month over 2 years, and so on, depending on your risk tolerance. There is a fair amount of debate surrounding dollar cost averaging within the financial world, and history shows that it tends to be less effective than simply investing a lump sum, but that doesn't necessarily account for human temperament and risk tolerance. If you're someone who might be liable to panic upon a steep decline, I don't think there's anything particularly wrong with investing gradually over time. It may also increase your risk tolerance over time as you start to get a better understanding of market ups and downs, and learn to weather those declines that might previously have seemed disastrous. Of course, it should be said that if a market decline in your investment really would spell disaster in your life, then that is probably money that you shouldn't be investing in the first place. Savings for a home, to pay bills, or any kind of emergency fund, common personal finance orthodoxy dictates, should not be put into the market. The risk is simply far too great. All of the thoughts that I've given up to this point have largely been made on the assumption that someone is investing passively in index funds or ETFs, and is letting the market do the work for them. I believe that the rules are slightly different if you are investing in individual stocks, and therefore in individual companies. In that instance, I personally would be very hesitant about investing in a company if I felt that it was greatly overvalued. It doesn't matter how wonderful a business is, much like it doesn't matter how wonderful a house is, if you pay 3 times its market value, that is likely to be a bad investment. The same rules apply to investing in individual stocks in the sense that you still cannot predict a broader market decline, and you are very unlikely to be able to predict, the timing at least, of the decline in a company's stock price. What's more, it would be particularly unwise to hold off on investing in a company that you believe to be reasonably priced on the hunch or hope that the stock was due to fall and that you could then pick it up for a discounted price, rather than for fair value, since that time may never come, and I have made that mistake plenty of times in the past. It is far wiser to buy a stock if you believe, based upon your own research, that it is a company whose prospects are good and that it is fairly valued, and then to add to your holding in the event that the price declines, rather than waiting for a decline that may never arrive. And if you are simply index investing passively over time, whilst I wouldn't dream of offering any financial advice, my personal view is that your best bet is simply to block out all of the noise. I invest in both index funds and in individual stocks. My passive investments are made monthly regardless of where the market is that day, week, month, or year. However, if there has been a decline of any kind, I will sometimes invest an additional amount that month in the belief that I'm getting a slightly better deal. That's because I'm someone who keeps fairly abreast of these things and checks my investment accounts on a semi-regular basis. For most people, the more you can simplify the process of investing, and the less frequently you have to log in and check your account or even think about it, the better your investments are likely to perform. Research by Fidelity a few years ago found that one group of people's investments performed better than anyone else's. Which group do you suppose that was? Young people? Pensioners? Doctors? Day traders? Nope. Dead people. Dead people made the best investors because they didn't mess around with their investments. They were all automated. No one panicked when the market declined and sold stocks. No one tried to time the market, and no one jumped in and out of stocks. You know, because they were too busy being dead and all. That seems like a pretty valuable lesson when it comes to trying to time the market. That is it for today's video. I hope you take something from it though, and I repeat this, nothing I say on this channel should constitute financial advice. Do your own research and just watch me for the lols. Thank you all as ever for watching. I hope you did have a good lol. Smash the like button if that was the case. Every time you do so, a puppy wags its tail in glee and the world is a slightly brighter place. And make sure to subscribe to The Reluctant Investor. You can also find me on Twitter via the username @ReluctantInvest or on Instagram via the username @TheReluctantInvestor, should you wish to do so.